Well, folks, the second biggest bank meltdown of all time actually took place over the course of the last 72 hours. As it turns out, Silicon Valley Bank is apparently not the only bank that has the same kind of issues that shut down Silicon Valley Bank. Signature Bank has also been closed right now. There is now talk about the possibility of other banks following in the footsteps of Silicon Valley Bank and having serious problems on their hands on their own. That would include, for example, First Republic apparently has similar issues to SVB. So we're going to go through exactly what happened with SVB, why it shut down, and we'll talk about whether there's a system-wide banking issue. The first thing to understand is that the reason for all of this is federal government mismanagement. The reason for all of this is because the federal government blew it on inflation and then had to ramp up the interest rates in order to fight the inflation. According to the Wall Street Journal, SVB Financial is the parent company of Silicon Valley Bank, which counts many startups and venture capital firms as clients. So this means that a lot of people are sort of laughing today because look at all the big tech bros who are about to go under. Now, here's the reality. What's actually going to happen is that the federal government is going to bail out the depositors, meaning that all of the people who had their money invested in Silicon Valley Bank, everybody who took their money and put it in Silicon Valley Bank and left it there, and then they would take swing loans in order to pay their staff, all those people will be fine. It's the bank itself that is going to shut down. This does mean the federal government is violating its own rules. The Federal Deposit Insurance Corporation, which is supposed to give you back $250,000 of your deposits, right? Every time you go to the bank, you'll see there's like a little sign on the bank teller window that will say FDIC insured up to $250,000. Well, most people who are running companies keep a lot more than $250,000 there. The FDIC is going to fill in all of those people anyway. This does create a situation of moral hazard. But what happened here is that SVB Financial, they had about $200 billion in total deposits by the end of the first quarter of 2022. That was a major increase in the amount of money that they had in deposits from the first quarter of 2020. In 2020, they had $60 billion in deposits. By 2022, they had $200 billion. Why? Well, because between 20 and 2022, we injected more money into the American economy than any time in human history. We just shoveled money out the door. And a lot of that money went to the big tech companies. A lot of that money went to firms that didn't know where to put the money, and so they started shoveling it at tech. Because remember, that was a tech boom. It was really a tech bubble. It was very reminiscent of the dot-com bubble of 1999, 2000, where all of a sudden firms that really should not have been valuated at the valuation that they were being provided were suddenly being valuated at extraordinary prices because people had money just gushing out of their pockets. Like, what am I going to do with this? Pets.com, I can go take my money and I can put it in some weird venture capital attempt and I can just throw the money at it because what else am I going to do with this money? And so all of those companies then took their money and they put it in Silicon Valley Bank. And so you saw the balance sheet expand dramatically for Silicon Valley Bank Financial. This created a question for Silicon Valley Bank because the way that banks actually make money, they don't keep your money in a lockbox. It's not like you have a safety deposit box and you bring in your $1 million and they take it in cash and they shove it into the wall or something. That's not what they do. Instead, it's all digital. And what they do is they then lend out the money to other possible ventures, or they go and they buy bonds, or they go and they buy stocks. They invest the money themselves, and then they essentially arbitrage the difference between what they have in their coffers and what they owe back to you and what they think they can earn from the markets. So what exactly did SVB Financial do with this massive influx of cash? Well, they started buying tens of billions of dollars of seemingly safe assets, primarily long-term U.S. treasuries and government-backed mortgage securities, which means that SVB's securities portfolio rose from about $27 billion in the first quarter of 2020 to $128 billion by the end of 2021. Okay, so they took all that money that was being thrown out there by the federal government, this inflationary wave by the federal government, they took all that money and they shoved it back into U.S. treasuries. Well, normally U.S. treasuries are supposed to be pretty safe, right? I mean, the way the U.S. treasury works is that you take $950, you invest it in a $1,000 bond, and that $1,000 bond is supposed to come to maturity in, say, 10 years. And that means that your rate of return on the $1,000 bond is, a few percentage points. And that's fairly safe because you know you're going to get that money back. The problem is, if the interest rates dramatically increase, then the value of your bond drops really dramatically. Because let's say that you buy a bond and that bond is going to give you a yield of 4%. And then suddenly there is an interest rate increase. And so the government is issuing bonds at a much higher rate. Well, then the market for your bond, which is going to earn you a much lower rate, the market just disappears. Suddenly your bond is worth like nothing because I can go down the street, I can get a brand new bond issued by the US government that is going to earn me a much greater yield than the bond that you are now currently. You're going to have to sell your bond at discount to compete with the new bonds that are being issued by the federal government. This is why when interest rates increase, the prices of bonds that are currently on the market tend to drop. So what happened here is that SVB Financial thought that they were being safe by buying a bunch of U.S. treasuries, but they were being stupid because they didn't look at the market and say, okay, wait, inflation is likely to follow here. And so when inflation follows, you're going to have to ramp up the interest rates. When they ramp up the interest rates, what is likely to follow is that the bond holdings that we have are going to drop in value. So if there's a run on the bank and all of our money is invested, all of their money, all of your money is invested in the bonds, we're going to have to sell off those bonds at a loss, and that's going to bankrupt the bank. That's essentially what happened here. We'll get to more of the explanation in just one moment. First, in this economic climate, pretty sketchy out there. You need to be cutting your monthly expenses because you just don't know what's about to happen next. Pure Talk saves the average family over $900 a year when they switch from Verizon, AT&T, or T-Mobile. That is correct. You can save $900 a year on your wireless bill and still enjoy ultra-fast 5G service. Get unlimited talk, text, and plenty of data for just $30 a month. Pure Talk is so sure you're going to love your service, they're backing it up with 100% money-back guarantee. Stop paying a fortune to Verizon, AT&T, or T-Mobile. Cut your bill in half with Pure Talk. Their U.S.-based customer service team makes the switch really, really easy. Switch over to Pure Talk in as little as 10 minutes while keeping your phone and your phone number. Your first month is guaranteed risk-free. Head on over to puretalk.com, enter promo code Shapiro, save 50% off your very first month of coverage. That's puretalk.com, promo code Shapiro. Pure Talk is simply smarter wireless. Restrictions apply. See site for details. Again, there's no reason why you should be spending your money when you don't have to be spending your money. And you can get the same exact coverage. I use it for my business calls, Pure Talk. They do a great job, and I'm saving money. puretalk.com, enter promo code Shapiro, save 50% off your very first month of coverage. A lot of people losing sleep over the state of the economy, getting those under-eye bags. Well, you can fix at least that part of your life by using Genucel Skincare. Sherry from Omaha, Nebraska says, I have sensitive skin. I'm careful about all products. My husband bought me Genucel bags and puffiness and Genucel deep firming serum. I felt it working immediately. My eyes look amazing and my face feels smooth and wrinkle-free. It's not just Sherry. Genucel has sold over 1 million products to both women and men across the nation. Say goodbye to those fine lines, wrinkles, even those annoying under-eye bags. Genucel will have you looking 5, 10, even 15 years younger, just in time for the warmer weather. Best of all, Genucel guarantees results in as little as 12 hours or your money back. I've been using Genucel because I don't get enough sleep. My wife's used it. My mom uses it as well. Try it for yourself. Get Genucel's most popular package, including their classic under-eye bags and puffiness treatment, for 70% off at Genucel.com/Shapiro. You get free shipping plus a luxury beauty box containing 2 free gifts with every subscription. Go to Genucel.com/Shapiro. That's GENUCEL.com/Shapiro. Genucel.com/Shapiro to get that free shipping plus luxury beauty box containing the free gifts at Genucel.com/Shapiro. Again, according to the Wall Street Journal, they bought all of these securities. The problem emerged is that because they pay fixed interest rates for many years securities, that's not necessarily a problem unless the bank suddenly needs to sell the securities. Because market interest rates have moved so much higher, those securities are suddenly worth less on the open market than they are valued at on the bank's books. And as a result, they can only be sold as a loss. Right? That's what I was telling you. The price on the bonds they had bought declined from when they had bought them because of the interest rate increases necessitated by the inflation. So as the Wall Street Journal says, at the same time, SVB's deposit inflows turned to outflows because clients were burning cash and they stopped getting new funds from public offerings or fundraising. So remember, all of their clients are tech companies. Those tech companies are very reliant on inflation. Those tech companies were burning through cash at an extraordinary rate. For about 2 years there, if you were a company that was in search of public financial capital, you would just seek to get bought up by what was called an SPAC. You sought to be bought up by a publicly traded company that didn't have any content to it. It was basically just a slush fund, and then it would buy you, and then you would become the publicly traded company. You've seen a few of these. Truth Social was funded through a SPAC, for example. But when all the money dried up, then suddenly all of these companies came up short. They've been burning through cash at this extraordinary rate because there was so much cash flowing through the system. And then interest rates increased. People stopped spending money quite as much. All the investments dried up. And at that point, everybody started trying to draw down their balance at the bank. Again, they keep a certain amount of money at the bank, like what they have to by law, but then the rest of it is being lent out or bought or whatever. And so suddenly, if everybody goes to the bank at the same time, you have the Mary Poppins scenario, right?
Give it back! Give me back the money! There's something wrong. The bank won't give someone their money.
Everybody goes to the bank at the same time. It's a run on the bank, and everybody freaks out because they have to shut the windows. There actually is no money at the bank. On Thursday, customers tried to withdraw $42 billion of deposits, about a quarter of all of the money that was supposed to be held at the bank, and it just ran out of cash. And then other banks started to get hit because there were other banks that were invested in this bank. Stocks of other mid-sized lenders like First Republic Bank and Signature Bank were halted on Friday morning. And in fact, Signature Bank essentially went into receivership for the exact same reason. They were invested in Silicon Valley Bank, and also they were heavily invested in bonds. And so the question becomes, okay, so what happens next? So that's 2 questions. Question number 1 is, are they going to bail out SVB? Are they going to bail out the depositors? How many other banks are in the vulnerable position that SVB was in? How many banks are not telling you they're in that vulnerable position? And nobody really knows the answer to that. So there's a lot of unease in the markets today because even if the depositors of Silicon Valley Bank are bailed out, well, what happens to all the unsecured credit holders in Silicon Valley Bank? There are a lot of people, in other words, who invested in Silicon Valley Bank. They're not going to get their money out. That money is now gone. And Silicon Valley Bank was a big concern. So that means those people are going to lose a lot of money, which means they can't hire. It means they can't fire. It means they can't, they're bankrupt, right? I mean, it can bankrupt a lot of people. And so we are in the same situation, financially speaking, that we were during 2007, 2008, when you had a bunch of financial institutions who were tacitly relying on the promise that the federal government was going to fill them in to make risky bets. And then those bets fail. And then the federal government does indeed at least fill in the depositors. Now, they're not going to save Silicon Valley Bank here. Silicon Valley Bank will not be a going concern from here on out unless there is somebody who comes in, sweeps in, and actually buys up the assets. Now, that could have been done on the open market anyway, right? There could have been, Elon Musk talked about buying up Silicon Valley Bank, for example, and then going and finding investors to fill in what depositors were owed. Because it's not like Silicon Valley Bank had no money. It's not like they went from $200 billion in holdings to $0 in holdings. They still were able to liquidate some of the bonds that they had on the market. They would need somebody to come in and buy them up and fill it back in, and people would presumably continue to invest in Silicon Valley Bank once they realized that the run was over. But that's not what the federal government did. So the federal government had basically two concerns here. Concern number one is making sure that this thing did not spread directly from Silicon Valley Bank to the rest of the system, that there wasn't a meltdown where depositors lost their money, and so everybody across the system went, hold up a second, my money is not safe at my bank. I'm going to go do a run on the bank right now. And because there is a sort of herd mentality when it comes to this stuff, is my bank safe? Are they doing the same thing? Are they lying to me? And everybody goes get their money at the same time, and suddenly a lot of banks start to go under. The other is the moral hazard created by the simple fact that over and over and over again, the federal government keeps doing things, and people keep relying on the federal government to fill in the gap. In 2007, 2008, the presumption was for everybody who was invested in subprime mortgages that the federal government was going to back their play because Fannie Mae and Freddie Mac, which were quasi-government subsidized, they were backing that play. In 2007, 2008, the smart money was that the federal government was backing subprime mortgages. So what's the big deal if we mix in a bunch of crap subprime mortgages with actually like good mortgages, and then we mix it all together, create a credit derivative structure that allows us to create a crap sandwich, and then everybody eats the crap sandwich, but most of the sandwich is not crap, so it's probably okay. Well, as it turns out, the federal government stepped in to save everybody from their own stupidity in relying on the federal government. Same sort of thing here. All of these companies relied on the federal government not to raise those interest rates to dramatic levels. That's exactly what happened with SVB. They said, yeah, we can see that you're inflating the currency, but we'll bet that you're not going to raise those interest rates to high levels, even as Jerome Powell was saying we probably will. And then, of course, things went south, and now they're going to get bailed out by the federal government. At least the depositors are, and it's a question as to how many other institutions are going to be guaranteed that way, which raises the question as to if depositors are just getting bailed out by the FDIC, then why exactly is the federal government subsidizing a bunch of banks in the first place to engage in investments they would not make with their own money? Because that's really what you're talking about here.